Good afternoon, everybody, and welcome to the latest Dunstan Thomas webinar. First one of a new year, and we're really pleased to have some really good speakers and a really interesting topic to debate. As with all these things, I'll introduce everybody in a second, but the thing that makes this really good is you get to drive the agenda. So for those of you who haven't been to one of these before, from a navigation perspective, at the bottom you'll see ask a question. At any point you can use that button to ask a question of any of the speakers, and I might well put the question to different people just to get some different views. What makes it really interesting is you can vote other people's questions up to the top of the pile. Inevitably, what happens in these sessions is we don't get a chance to cover everything, and there'll be some unanswered questions at the end. But in terms of the ones that we do get to, that's all done by the attendees voting them to the top. So that's what makes this really interactive. You can put comments in the chat as well if you want to kind of contribute to the debate. And if the debate's really interesting, I might even invite somebody else to the screen, but we'll see if my emceeing abilities runs to that. So this is the second ESG related webinar that we've run. The last one was all about greenwashing, and the response was really good, the feedback excellent, and plenty of requests to revisit the topic. So that's why we're coming back to ESG again. On the webinar with me, I've got Manjit Jess. Manjit's held several roles in ESG research and technology, and his previous company, got bought by S&P a couple of years ago. I think your 2-year anniversary roundabout now, Manjit, is that right? And Manjit is now managing director and responsible for S&P's approach to ESG in a kind of global context. So that's going to be really interesting from a data reporting and obviously more than a decade's experience in the field. Graham Presley, so actually Manjit's in Switzerland, so we've got a really European focus. And Graham Presley is actually is it Normandy at the moment?
Graham, yeah, I live in France.
Yeah. So Graham's had previous roles at L&G, where he was head of their sustainability, and 10 years there, and now involved at board level with a number of organisations looking to positively impact on the world, including the For Cancer Group, New Haven Regeneration Group, and I'm sure he'll be able to tell us about a few more of those organisations that he's involved about as part of his own personal intro. And Adrian, I've introduced on these a few times now. Adrian's a kind of regular contributor to our webinars. He's Dunstan Thomas's retirement strategy director, and you'll have seen him on many occasions in trade press commenting on ESG and plenty of other investment and retirement related topics. So welcome everybody. We're going to have basically a kind of 5-10 minute intro from each of you, just to kind of talk about some of your experience in the sector and your thoughts on kind of emerging events in the ESG space. Obviously we're positioning some things particularly around why is E seeming to get far more traction than S&G at the moment. Where are we at with reporting standards, and how are companies responding, both from a kind of corporate PLC perspective, but also advisors, investors with portfolios of money invested in terms of responding to the definite uptick in interest around ESG at the moment. So I'm going to hand over first to Graham. And then we'll come back for Manjit and Adrian a little bit later on. Graham, over to you. Thanks for attending today.
Yeah, no worries. Thank you. Just a little bit of background. So I cut my teeth on sustainability, if you like, at Legal and General Group, where I was responsible for the ESG performance of the group. So we owned a lot at L&G. So we had a lot of investments, whether they were infrastructure or equity and debt investments, and also we had to justify our ESG performance to our own shareholders. So it was an interesting place to be, keeping what others expected of us in terms of standards of running the business. lined up with what we expected others to do. I just wanted to spend a little bit. So currently, I work with lots of organisations, including Curtis Banks. I've just looked at the ESG strategy for Curtis Banks, the owners of Dunstan Thomas, and I'll talk a little bit about what we're focusing that business on. So what's ESG all about? It's really confusing for people wanting to put money into business right now. But what's ESG really about? Well, actually, ESG is just about how does that business make the money that it makes. It's the how rather than the what. The other piece, increasingly important to ESG, is there's just a huge amount of change going on in the outside world that is affecting business, whether that's the environment, how society is changing, how the economy is changing. And increasingly, companies and their investors in those companies are asking those companies, how are you trying to get your head around the future? We would call that R&D. So for me, ESG for a lot of the time is about de-risking a business, but it's also understanding how you go about understanding what in the future will either kill your business or grow it. And it's really important to go back to basics on why the ESG data industry started in the first place. Many moons ago, and even today, companies misbehaved. They cut corners. And so, fueled by mainly NGOs and non-government organisations, the ESG industry started because it was trying to call out businesses on bad or poor performance. And then what you saw in the development of the ESG data industry and the ESG analysts was that they promised companies that, look, if you disclose data to us on how you perform, we'll put it into a financial model and it will give you more broader shareholders. It will help you access more funds to run your business, to do what you do as a business day in, day out. So there was an exchange between ESG analysts and companies. A simple transaction. Give us your data, we'll analyze it. If you're good, it will lead to more people investing in your company and for you able to do more of the good stuff that you do. Right now, I think we've lost that, which is why we're in a little bit of a mess with ESG. And then the other thing, which was really super important, is in the economy, there are industries that the society needs less of, and there are industries that need to adapt to help us in the future. So the classic example is the ESG industry, and ESG data is hugely useful in moving money from high carbon intensive industries to lower carbon intensive industries. So ESG houses play a really important role in shifting money that's in the wrong place into the right place in the economy. So where are we right now on ESG? It's pretty difficult, and I say this from a company perspective. There's some big stuff going on in the world that needs fixing, frankly, that makes people's lives better and will slow down climate change. Companies are having to disclose a huge amount of data. Back in November last year, I spoke to 17 heads of sustainability, and they all said the same thing. We are being asked so many questions about how our business operates. It's become overwhelming from ESG analysts. The other thing they also said is the questions we get asked, frankly, never really touch what we actually do day in, day out as a business, what we're in business to do, our products or services that we offer our clients. They tend to ask about the stuff around the edges. We also know that investors are confused, and just looking to what the FCA did last year, suddenly after COVID and because of some of the COP26 impacts, the FCA saw a huge amount of funds suddenly being registered as ESG funds. And from what I can see, it was just existing money with a couple of extra measures over the top of it, which is fundamentally not what ESG funds are about. And quite rightly, in my opinion, the FCA said, no, that's just rebadging existing money. It doesn't fulfill the need to move money into new parts of the economy. And some of that money needs to shift from from old economy to new economy. So what I'm seeing in my experience with companies is they're pushing back on ESG analysts, ESG investors, because that promise to find new shareholders and new forms of money for their business to fuel it, money is just energy, is lost. So I think we're in an interesting place. As an investor, it's really hard to know who the good companies are with long-term value that are going to solve the issues the world wants fixing, and who isn't. And a lot of that is because there's just too much data out there. So what do I think is going to happen in the future? What am I seeing companies doing right now? Companies are a lot more confident right now on telling their own story from the inside out. And they're calling it purpose, but fundamentally they're saying this is what our business will do. This is its impact in the world. We are prepared to prove it ourselves. And we no longer need to keep disclosing data that's got nothing to do with our business to ESG houses that can no longer bring us new capital to run our business. So I think ESG houses need to repurpose themselves to remind themselves why they were there in the original mist of time, which was to improve performance of misbehaving companies and to find new forms of capital for the businesses that we need in the future. And there's one final thing I'd like to leave you with is there is an opportunity here. One of the things that ESG analysts and businesses very rarely line up is where their balance sheet is investing. So you will see an increasing number of companies commit, for example, to things like UN Sustainable Development Goals. We are going to give more people access to water around the world. We're going to improve their health. And companies do that with their products or services. But I think the real superhero, if you like, in the sustainability or ESG world over the next couple of years will be the corporate treasurer, the person who typically invests the deepest and longest form of capital for the business and very rarely talks to the ESG professionals in the business. And if companies truly are committed to solving some of the big issues in the world, which is what ESG is all about, where are you heading? What are you going to fix for real people? Then the corporate treasurer, in my opinion, is the person that ESG analysts need to be talking to more over the next few years.
Thanks very much, Graham. Really, really interesting. And we're not going to ask kind of questions before we get on to the group part at the end. So I'm going to try and do the whole DJ thing. Is Manjit again? Welcome. I think we got you in focus now. So over to you for your intro.
Yeah, thanks a lot, and thanks, Graham. I think you summed up, I think, a lot of the challenges that we as an industry face today, and are certainly doing our best to address. I've been in the space for a while. I started actually in an asset management company, one of the pioneers in the sustainability space, trying to figure out these questions about how do we find missing pieces of information that we think are important to determine on whether a company is not just good or bad, but whether they will be successful in the long term, and call it sustainability or non-financial information. Now ESG information, I guess it's had many names over the course of the last couple decades. That was kind of the primary objective, and really the only way to get that information was to form relationships with companies, as Graham correctly pointed out. And it was basically back then picking up the phone and calling companies and asking them very uncomfortable questions about their water consumption and energy consumption and things that companies didn't really understand. Why is this important, and why should I be disclosing this? We've obviously come a very long way, but for us it was also very much being an asset manager. It was very much having to argue why this information is important, not just because of the impacts it has on the world, but the impacts that it has on a company's bottom line. And I think over the last 20 years, what we've tried to play a part in is to better help companies understand the relationship between sustainability objectives and how it actually makes their business better and stronger and more robust for the future. And I do think that we continue to do that. I agree that the narrative has maybe changed a little bit, and it's also the narrative that we're hearing from investors. For a very long time, we had to prove that a sustainability fund or integrating ESG information into kind of a financial investment process was better, and it was the right thing to do. because it offered, either risk reduction or some, others were looking for alpha. And that was really the selling case. Otherwise, no one would take you seriously. And now I think we've seen this massive paradigm shift in terms of how ESG is looked at. And with that, I think that the narrative has also shifted, where I think more and more investors and more of our clients are kind of saying, well, okay, it's nice that this is having an impact on the company and its bottom line, but what are the impacts on the world? And I think that is very different as well. I think very much in line with what Graham said. It's about having impact on the world, and I think companies now today very well understand the relationship between saving energy and saving costs, or minimizing environmental damage to avoid fines. These are things that they've understood for a very long time, and I think executives and boards are also warming up to this idea that not everything maybe has to be associated with kind of a dollar value. It is sometimes about doing the right thing, and because you're doing the right thing, benefits will follow, because your reputation improves, your relationships with your stakeholders improve, you're less likely to be to suffer because of new regulation that's coming. And so that's one part of the narrative. But on the other side, I think the narrative has also changed in the investment community, and that does require, I think, a shift in data that we're looking for, data that we're collecting. But it also means that there are many use cases, I would say, for ESG data today. We still have people that are just starting that ESG journey, that don't understand it, that need something simple. We have companies that are only beginning to kind of look at sustainability and what it means for their organization and for their kind of future development. And on the other end of the spectrum, which you didn't have 10 years ago, you have super advanced, highly sophisticated investors that have completely different needs when it comes to data and ESG. So also from our perspective, being kind of in the middle of companies and investors, it is challenging, because we realize that there is really no one size fits all approach. We work with thousands of companies every year. The very advanced companies want us to keep adding metrics to our methodology that assess them, that challenge them, that are more forward-looking, that, to Graham's point, allow them to demonstrate that they are not just thinking about the past or the kind of current state of things, but are thinking about the future and impact. But those questions are not suitable for an SME or a privately held company that is only for the first time starting to look at what ESG means. And on the flip side, for investors, you have investors that are very happy with an overall ESG score, because that's what they can deal with. But you have others that need a whole range of analytics, and they want to go down into the detail. They want thousands of data points because they want to interpret them for themselves. So I think the narrative has shifted, and certainly we see that kind of impact focused investing is a small bubble in the current investment market today, but will continue to grow. And certainly more advanced companies, to Graham's point, are certainly also shifting the way they think about and communicate about ESG, because similarly to the way funds have been maybe relabeled or repurposed as being sustainable, what we also saw with the release of the Sustainable Development Goals was kind of this reverse engineering of, well, we have some metrics, we have things that we're reporting on, therefore we can map this to an SDG. But again, that's not really the purpose. It's about finding how these things are strategically linked to the purpose of a company and how they are doing business and the products and services that they sell. Thank you.
Thanks, Manjit. Let's get Adrian up on screen here. Adrian, I think that
Wonderful.
should be you, ready to go.
It is
Thanks.
indeed ready to go. Thanks, Andrew. Now, I'm thinking about ESG from the point of the retail investor, where there are upsides and downsides. And the upside is that investing in funds that predominantly invest in companies with good ESG credentials should deliver good returns, provided those companies are the ones that will be delivering the goods and services that we'll all need to be consuming in the 2050 zero carbon world. Potentially, that's the happy combination of investments that deliver good returns, so you have a good pension, and at the same time foster a good planet and a nice society, so you've got somewhere to really enjoy your retirement. The downside risk is the sort of flip side of this. Investing in old world companies is unlikely to deliver you the sort of 20, 30, 40-year investment returns that you need for the long duration of pension planning. But I worry that the risks today have become very asymmetric. What I mean by this is I think that the discovery element of ESG investing has already been captured. We've seen big upswings in the performance of environmentally responsible companies and funds already, as it was during 2020 and 2021 that investors really caught on and moved money into ESG friendly funds. The first movers got in early and it did very nicely, but the bandwagon now has perhaps moved on a bit for anybody joining it now. Yet on the downside, I think it's still really hard to predict where the big failures and the big losses are going to be. Who is going to be the next Kodak? The company whose CEO Kay Whitmore famously declared, "I will make sure Kodak stays close to our core business of film and photographic chemicals." And we know what the digital world did to him. So if you take, for example, the 10th largest company in the FTSE 100 today, they're a major constituent in tracker funds and many other equity income funds, and you look at them, their website tells me that they're into offshore wind, onshore wind, solar farms, sugarcane ethanol, and they're also building a huge hydrogen plant on Teesside that's going to produce 1/5 of the hydrogen the UK government's net zero plans require. A word search of their third quarter results shows no mention of the word shale. But when I look on Forbes as an alternative information source, I find that this company, BP, formerly known as British Petroleum, has $10 billion worth of US shale assets, which it's purchased within the last 4 years. So the difficulty for an investor is BP going to be a winner that successfully transitions to a low carbon economy, or is BP going to be a stranded asset that will end up worthless within my pension fund? And I simply don't know. I'm hoping that the new ESG disclosure regimes and yet more metrics will help my fund manager make the correct call on BP. Now, many retail investors would like some simple signposting, and perhaps the EU Sustainable Financial Disclosure Regulation will give them that. Look out for funds that are labelled Article 8 or Article 9. Those Article 8 funds promote environmental and social characteristics, and I think this and the FCA equivalent of it, which is coming down the road very shortly, will be a healthy watchword for investors. Just like any electrical equipment I use at work has a sticker on it that says it's been PAT tested, so I know it won't electrocute me. Make these Article 8 funds form the core of your portfolio. The Article 9 funds are for those that like to wear the hair shirt. These will follow bespoke strategies targeting specific measures on, for example, climate change or gender equality. Sometimes you may hear this sort of thing referred to as impact investing. Currently, only 7% of retail funds are Article 9 compliant, and this suggesting to me that these funds should perhaps be only a small part of your portfolio, satellites that complement your core funds. But hopefully this sort of Article 8 and Article 9 labelling will provide that sort of simple signposting that I know many retail investors are hoping for. Just to sort of finish on what else a retail investor can realistically do today, I say give your funds the top 10 investments test. Your investment platform, or indeed the fund's own fact sheet, will publish the top 10 companies that an equity fund invests in. Then a few minutes on the internet, using both official sources from the company and perhaps wider inputs like social media, will tell whether these companies are aligned to your values or not. And then make your own mind up whether you're happy with this fund or not. If most of the top 10 funds align with your ESG priorities, then it probably is a fund that will suit you well. Or maybe like me, you're a bit more demanding. I discard any active fund that is a tobacco company in the top 10. But that top 10 test is, I think, an easy test that any retail investor can do using the easily available published information. Thank you, Andrew.
Thanks, Adrian. I'm just going to get everybody's video back up and running. So will this work? There you go. Love it when a plan comes together. Thanks, everybody. There were three really good, interesting, challenging intros. We've got a few questions that have started to come through. Obviously, if you've got questions to ask, and now's the time. I'm going to start with the top question here, which is, I guess we'll start with Manjit, and probably everybody else will have a view on this. But if ESG ratings are an opportunity to clarify corporate's wider value and purpose to society at large, what do the ratings companies need to do to ensure the result is produced efficiently and accurately? One of the real questions of the moment, I think, that one.
Yeah, sure. And you know, it's an uphill struggle. You know, there's data availability issues. There are gaps in information. There are, you know, quality issues. There's the issue that data isn't available in a format that's easy to digest, which is kind of, you know, a core struggle for the industry, is that, you know, we still have a lot of manual kind of data collection that has to happen, just because the way data is presented is not, you know, meant for the, you know, kind of large scale data collection and aggregation. You know, we spend a lot of time reviewing data that's publicly disclosed and disclosed to us by corporates. You know, on the environmental data side, it's you know, up to 40% of data that's reported is corrected because it's not right, and that's basic stuff like, you know, greenhouse gas emissions. So that's one issue. You know, on broader ESG topics, it's sometimes up to 30% of data that we have to either modify, you know, correct, or, you know, outright reject because it's not correct. And this is data that sometimes has even been third-party verified, so by a third party, by an accounting firm. So there's issues in the data, and there's a lot of work that has to go into contextualize the data. So it's getting better. So that's certainly the case, and disclosure is certainly improving. The lack of standardization is obviously an issue, and we would love to see, you know, convergence around, you know, what to report and how to report it, and it's really getting into the nitty-gritty weeds of you know, defining something the same way. So when we talk about a specific data item, you know, do we mean the same thing, or do we have to go read a footnote somewhere because a company has reported a number, but then in the footnote it says, well, we've reported the number, but we've decided to exclude, you know, this part of our business and this part of our business and this part of our business. So that requires a lot of manual work, and I think there's a lot of stuff underway with the IFRS, you know, work being done, and kind of, you know, all the standard setters for reporting coming together and discussing this. So it's being tackled. It won't be resolved overnight, but it's certainly coming. That makes it easier for us, and it makes it easier for companies. To Graham's point, like if we could all agree as an industry on some core ESG metrics that we think are very important, then it would make getting that data much easier. It would be much easier for companies to report that data. If we all have our own kind of versions and flavors of things that are, you know, essentially the same, that poses a problem, right, for a company, and this kind of reporting burden, or this additional reporting kind of fatigue that's created through that, is obviously a huge problem that I've been hearing about since I started working in this space. And then I'll combine this with another question that I think is linked to this: is how can AI and machine learning, you know, help?
Yeah, I was going to link the two, actually, so you beat me to it.
You know, the problem on kind of reported ESG data, the problem is still that you need that context. So you can scrape data, you can put it together, but if you don't have an analyst or a gatekeeper before that data, it kind of enters into your system and then into your rating and then into your score, and you didn't catch the footnote that said, well, this number is, you know, kind of what I was expected to report, but not really, it's a problem. So, you know, we take that approach. I think we're obviously looking at that, and we use that in parts of our business where we think it's valid, but we're, you know, cautious. What I will say though is more and more alternative data. So I think, you know, if you're looking at impact and if you're looking at risk, there is tons of information out there that tell you more about a company's impact than what they would report. So by assessing what a company is selling in terms of products and services, like are they, is the majority of their revenue coming from sugary drinks? The company doesn't need to report that. They can report all the initiatives in the world that they're doing to improve, drinking water around the world. That is part of their kind of corporate sustainability strategy. But if their core business is selling sugary drinks that leads to diabetes and social costs for kind of broader society, that's something that I don't need to ask a company. And I think that's something that we're seeing increasingly, with climate data. It's the same thing. I can take satellite imagery. If I have your asset level data, you don't need to tell me about like your programs. I can calculate what your climate risk or physical risk is. So what we're seeing is a marriage of kind of corporate data that's being reported with alternative data sets, makes it much more efficient, and it adds this outside-in view on a corporate that's quite unique. And then you kind of have to rely less on massive amounts of disclosure because you can come to a conclusion around impact or risk relatively quickly.
Thanks, Majid. Before I come on to Graham, just a comment. I mean, just from a sense of scale, obviously the kind of the whole manual nature and the analysis side of this, so you hit on a few times there. In terms of S&P's kind of global presence, any idea of the number of people involved in ESG in some way, shape, or form? I mean, I'm guessing it's a pretty large number.
I mean, we obviously have many divisions, and we have our index business, and we have our credit ratings business, and there are obviously a lot of people doing great work on ESG there. The organization I work for, which is Sustainable One, which kind of sits within S&P, was formed at the beginning of last year. We are about 500 people and growing very quickly. But if you just think about analysts that are collecting ESG data, and I think this holds true for our colleagues at MSCI or Sustainalytics. I mean, these are teams of hundreds of analysts sitting around the world in different locations, collecting basically the same ESG data. Much of that data collection is manual, extracting it from company PDF reports or corporate websites. So it's a huge engine just to get the data that we need to then even begin creating some kind of intelligence and analytics around it.
Yeah, no, that's helpful. I think for everyone on the call, that gives a sense of the scale of effort and kind of industry overhead involved in this at the moment. Yeah, thanks for that. Graham, over to you.
Yeah, just the data burden's an interesting one, and it's as much the company's responsibility. To be honest, if I've got a client, for example, who said that I'm getting asked loads and loads of questions about ESG from analysts, and it's taken up a huge amount of my time, it suggests two things to me. One is the business is not clear on what it's focused on, what it's going to work on in the world. So, what is it you're actually going to fix with your products and services and make life a bit better for the long term? So it says the company has not worked out what's material and what isn't. It also suggests that the analysts are asking questions that have got nothing to do with what the business does. If there's a data burden, it's because there's a misalignment between what the company does and what's being asked of them. And either the company is gone down the wrong rabbit warren, if you like, in terms of their focus, or the data analysts don't understand the business. And I think companies have got to do a better job at going, look, these are the two things we are going to focus on in the world. So a very simple, when I did a review for Curtis Banks, we're focused on intergenerational fairness over the long term. But how do we keep pension customers with relatively large pension pots? How do we keep them away from the state having to provide anything for those people for generations? And that has business value to investors because that business is in the business of keeping those assets on platform, looking after customers long term. And the second thing that we found, so that's focus number one. The second thing is they're a massive landlord. So actually their customers are putting, typically SME owners, putting their pensions, their properties that they're running their business of into their pensions. Well, the question is, for the future, coming back to Adrian's point, should we be encouraging customers to own and run more environmentally efficient buildings as opposed to not? Because actually, the future is going to get very expensive for buildings that are not efficient from an environmental, the cost of business in those buildings is going to go up. I think, and I think there's one regulatory piece which I think needs to change to make it easy to get companies, particularly around the S in ESG. There's a lot of metrics around S in the market, but I look to what charities, trustees have to do every single year in the UK, which is to write a public benefit statement that explains to their donors, investors, how society has benefited from the deployment of this cash. And I think one of the steps missing for companies is that the company directors should be having to disclose the same, which will start for them to be held to feet to the fire on the impact of the societal impact of the business. And then I think we can have some certain metrics underneath. But directors having to answer that question is a good step from a regulatory perspective.
Thanks, Graham. Adrian.
I think this issue about can we produce this, ratings efficiently and accurately is a very interesting one around, are we trying to all measure the same data? In other words, is it a factual thing? Or is it actually a kind of subjective assessment? And I liken it to my experiences elsewhere in pensions, in that when we're doing charge disclosure for a pension scheme, we know the charges are straightforward, they're factual, and the industry's made quite a lot of progress towards a simple factual disclosure of the charges that you'll pay on your pension scheme. But then when we look elsewhere in the industry at things like underwriting, if somebody has come for some life assurance or if they want to buy an annuity, then we underwrite them. And that's a very subjective opinion. And different companies will ask different questions, and different companies will take a subtly different view of the importance of a particular health condition that somebody might or might not be suffering from. That health condition will worsen their life assurance rates, of course, but improve their annuity rates. And I kind of see the same here in the ESG. Some of it could be quite factual. And we might be moving towards things like the amount of carbon that's produced by a company. We might have some fairly factual ways of disclosing that. Others of it in terms of assessing, what is their business purpose, where are they going, where are they trying to take the world, that seems really rather subjective to me. And I would expect, therefore, that different ratings agencies will be asking different questions and will come up with different answers. But that's part of the fun of life. You don't want one answer, you want multiple sources of information as an investor, and you look at several sources and then make your own mind up whether to buy or sell.
It's a really interesting point, Adrian. I know you've been, like me, you've been to a few AGMs. The beauty of a good AGM is you can see the data, you can have it in advance, and then you can ask real questions to real people. And that's what we're kind of missing in the ESG world at the moment, is the real conversations. I understand the data, but for the executive, tell me how this really works.
Yeah, no, interesting. And I think, linking back to that AI question, it's almost more soft, nuanced, narrative type information that might be the thing where AI, machine learning can really start to, add that additional analytical power to what is a huge, there's a lot of data globally. So who knows? Be interested to see, 5 years from now, if we get the same group of people around, have we fixed it, and what was involved in fixing it? And how much did AI have a part in that solution? Okay. So let's move along to next question. So, Adrian, probably one for you. Graham, I don't know what obviously you got the LNG experience, but I don't know about the pension specific side of things. But Adrian, what does it mean for pension trustees? What is expected of them within the next year? What are the big changes?
Well, they've got to tread quite a tightrope, Andrew. The legal bits are relatively straightforward, and the scheme lawyer will have explained to them that they need to consider ESG within their investment decisions. They need to have an ESG strategy. They need to reflect it in their statement of investment principles. They need to have an implementation statement that they'll publish to members, saying, this is what we're doing on ESG and how we're progressing. The difficulty for them is that at the end of the day, their fiduciary duty is still to their members. So they have to sort of balance the issue of trying to say we've got to get a good investment return for our members against we want our members to have a nice planet and world to retire in. So they will tiptoe around the areas like impact investing, and if they're going to go for something which is going to improve society, they've kind of make sure they go for something which will get them an investment return as well. But they're having to balance those fiduciary duties against what is quite a lot of pressure coming from government, with government saying we want more money invested in the sort of infrastructure which is going to change the country from where we are today into a low carbon society. A feeling amongst government that maybe those trustees are a blockage that is somehow preventing that flow of capital. And if trustees allow that feeling to, persist, then they'll probably find legislation, being wielded against them. So they've got a tightrope to walk here between doing the right thing for their investors and keeping the government happy at the same time.
Thanks. It'd be interesting. I mean, is anybody aware of anything that's happening globally with pressure on pension funds to do the right thing? Is this a very British pressure, or is it a common thing globally? I don't know, Manjit,
I think we're slower than much of the rest of the world, Andrew.
Right.
And I think if you look at Australian pension funds and Canadian pension funds, then you'll see that they've been faster in terms of sort of, grabbing some of the new opportunities and moving faster into things like infrastructure and illiquids. And in the UK, we've been held back, not particularly, I think, by trusteeship, but I think more by some of our structures around the sort of desire to make sure that all our funds can be priced every day, to make sure that investors can switch in and switch out. And maybe that's understandable because we've seen some people burnt on that. Famously the Neil Woodford funds that invested in a sort of reasonably high degree of illiquid investments. When push came to shove and their investors wanted to walk, they ended up closing the fund and the assets got sold off in a fire sale. And I think the investors didn't do very well out of them. So you tread a delicate line here, but the system that we have in the UK, that the funds are daily priced and everybody can sort of rush off in a sort of Walt Disney run on the bank style scenario, is difficult in the UK.
Thanks, Adrian. Let's go to the next question then. Time's moving on. So next question is, has there been an overemphasis on net zero targeting? This is kind of the point I made up front. Climate change mitigation at the expense of disclosing factors which help build a more just, fair society, as in the S&G parts of that. And how do we see that balance being redressed, if at all? And I know you kind of touched briefly on it, but Graham, is that a concern that you share?
Yeah, the net zero is. I'm going back to my A-level chemistry days, right? That's all that net zero is about. Is there's a certain amount of carbon going into the atmosphere, and there's a certain amount that needs to come out, and it's a simple chemical equation, right? So there are most businesses, the fact that they're in business, are emitting carbon. Most businesses in the world, they are polluting from the morning they open the doors of running the business, whether that's through a data center or increasingly digital. The reality is to balance that equation, to get to net zero, we need plenty of industries taking carbon out of the system. And so you either transition companies. Most companies need to do less. But actually they'll get to a certain point where they can't do any more, and they need the industries that take carbon out of the system to work harder on their behalf. And money really at the highest level is only energy, so there's a lot of energy that needs to shift to taking carbon out of the system for those that emit carbon to do a better job. And it's as simple as that. And there are a few examples of companies starting up right now that are able to take carbon dioxide out of the system, but not enough, frankly. And that's the net carbon debate. I think companies can go so far, but the fact they're trading means they're emitting, and we need to be putting a lot more money into companies that take carbon out of the system.
Thanks, Graham. But Manjit, how do we get more of a focus on the S&G parts of ESG?
Well, it's harder to measure. Going back to the comments around subjectivity, it's E is it's scientific, right? We can measure it. It's been measured for a long time. There's hard metrics. We're talking about numbers. Net zero commitments. These are bold statements. We have, I have my concerns around how some of the companies that have put out these statements are actually going to get there. So I think the next years will tell whether there are actions that underpin those commitments. But it's something that's easier to measure. So I think just because of that, the E part, I think, gets more attention. It's obviously something that's very prominent in kind of the way we think about the world. S is very local as well. It's a very local, regional conversation about diversity, what that means, inclusion, what does that mean? There are legal constraints about what you can collect around S metrics. So, in France, there are many labor type metrics that you cannot collect, and companies tend to hide behind that because they're not allowed to collect certain diversity metrics. In the US, there's a lot of attention around this, so it becomes a bit of a disjointed conversation, which makes having a kind of global view on S more difficult because it means different things to different people, and you have to take that very, very specific local context into consideration. And for a company that has offices, all around the world, hundreds of thousands of employees, there is no kind of one size fits all. It's not like let's go and reduce our energy consumption. So that's certainly a challenge. I think part of the question, at least that I read, was how do we not forget that? I mean, I think what you hear now is people talk about a just transition. So if we're talking about transition to a low carbon future, if we're talking about divesting from certain industries from an investor perspective, that doesn't just have positive impact on the environment, but there are potentially severe social consequences that come with that. That obviously regulators and others are debating as well. And I think we've put that out as we've put that out as kind of one of the trends to watch for in the coming year is kind of the debate around a just transition, and we do think that the S will be featured more prominently. But again, it's harder to measure, and so you kind of go with the things that are easier first and leave the things that are more difficult to tackle as second. But yeah, we I think also COVID and these things that have been happening to the world have put a bit more focus on the S part of it. Future of work, the Great Resignation, all these buzzwords that you've likely heard. So yeah, certainly some movement there, but it will continue to be difficult to measure.
Thanks, Manjit. I'm going to kind of try and rattle through a few questions by asking just specific people to answer them. So I think, Graham, if you can take this one, because it'd be interesting to get your perspective. So if you were advising a startup company now to think about ESG, what would that advice be?
Just be clear on so be clear on your what you are going to add to the world with your products and services. So you can articulate. Environment is a science. I totally agree with that. It's numbers, understanding them, and so I think being super clear on the things that your business adds to society over the long term by you being in business or not, and being able to articulate that with the owners. That's where you need to be super clear right now.
I guess there's quite a few companies who are kind of almost rewriting their vision statements at the moment.
Yeah, I mean, Unilever's the society, the S in ESG. Fundamentally, the question that any company's got to ask is society better because we exist or not? I mean, that's it. It's long term, and Unilever, for example, is taking a lot of flack at the moment because it's trying to ask that of mayonnaise and Marmite and whatever else, or its products. but actually it had this sorted. Lifebuoy soap, going back to that example, had a very specific human impact. It stopped disease because you washed your hands. And I think the companies I talk to are trying to get back to, particularly in the physical product world, what is it? Why did we design this in the first place? What was the impact on real people? And can we get to that? And there will be some products where it was, no, it's just shampoo, it's to wash your hair. Let's not pretend it needs a purpose. It's just to make you feel good, as opposed to this soap actually was created because it avoided people getting sick. And I think companies are trying to get to, in the physical product world, how is this product really making a difference to people? And some are going to struggle with the answer beyond it's just going to make some money.
Excellent, thanks. I'm going to break my rule a little bit and ask a question further down just because I like it. And I'm going to start with Adrian. John asks, what does the panel think about the position taken by the chief executive of Aviva Investors, who has warned it will take action against company directors if they do not meet its expectation on sustainable improvements?
I
don't know whether you read that in the press.
I had.
Yeah.
I think it's a splendid idea, Andrew. I think it's another example where Aviva are leading the way. They've already done this in their general insurance department, and if you're a company and you're operating in a high carbon area and you are not adopting a strict plan to show how you're moving from high carbon to low carbon, then Aviva are not renewing your general insurance. Say your buildings insurance, your employer's liability, the insurance on the fleet of company vans and cars and stuff. Aviva are politely saying, sorry, matey, you're high carbon, you're not transitioning, we aren't going to deal with you. And I see this that John's raising here as an extension of that, with Aviva investors saying, look, we're going to take stuff against you. And I think that's splendid. It's not just about boycotting people. It's about positively encouraging firms, individuals, and company directors to be doing the right thing. So good on them.
Just to comment on it, I think it's a carrot and stick strategy, right? At the beginning, you say this is the reason why we need you to change your behaviour, and you give them warning, but there has to be a stick that says there is a point at which not going as fast as we need you to has a consequence. And I think it's super important. I would say that if Aviva or whoever takes a stance, then the massive impact is that they then need to make sure their own balance sheet is not exposed to those companies either. It's either you're all in and saying, actually, we genuinely believe that these companies need to transition, and we are going to look at everything we own, and we're out. Once we're out totally, not partially.
Interesting. I lived and worked in South Africa for 7 years. Anybody familiar with the South African economy will know, words like affirmative action, black economic empowerment, and it's almost, a similar kind of drive to overly emphasize and, favor certain behaviors over others. But Majid, I don't know whether you want to come on that one as well.
Yeah, no, I think just maybe more broadly. I mean, I think, this question around accountability and driving change is something that is hotly debated, right? It's also the ongoing debate on, do you divest or do you engage? And I think there are, different views on that. Both have their merits, but certainly, I think engaging and trying to create accountability for actually, real change, I think is important. And we see that's, it's also emerging, and, things like TCFD guidelines. I mean, there is this kind of emerging thing that if you are saying things, you also need to kind of show how your board, how your, executive management is truly committed to, climate topics, other topics. So I think, I think it's, just making statements without, demonstrating that there is actually good kind of governance around this is something that will be questioned more and more, and I think will be very difficult to kind of wiggle your way out of as a company.
Yeah, excellent. Thank you. Next question. I think Sam gets the award for the number of acronyms in any question today. I'm going to start with you on this one, Adrian. What are you expecting FCA regulation to demand, and is it likely to follow existing sustainability reporting frameworks like the, wait for it, EU SFDR or the SASB ESG guidance framework and the new EU taxonomy?
Splendid. Well done. Thank you, Sam. Yes, that SFDR is the EU Sustainable Financial Disclosure Regulation. We're getting quite a lot of alignment here. And this isn't just a matter, I think, of FCA following Europe. I think we're seeing a lot of global alignment. And a lot of this actually has come out of COP26, because what most of us didn't realize was that COP26 wasn't just about the main auditorium, where Boris and some world leaders went, and after a bit of argy-bargy, they decided to reduce methane and stuff. A lot of COP26 was people that got together there and were thrashing out a lot of the detail. So if you are seriously into this disclosure, then a lot further detail and a lot of alignment on that detail was hammered out in the back rooms in COP26, and is published by the UN. There was an enormous amount of material published at the end of COP26. That's really, really good news for us all. And what it does mean, yes, I do think that the FCA will follow very soon on from the EU requirements, which are already set out for those Article 8 and Article 9 funds that I mentioned in my introduction. Very similar, I think, coming from FCA and coming very quickly.
Yeah, Graham, share the view.
Yeah, I look at for me one of the important moves. So Sasha Sedan, who was head of corporate governance for Elgin, is now head of ESG for the regulator. I use the term poacher term gamekeeper quite frivolously, but actually Sasha has a massive knowledge of how to get money moved into the right places and how to challenge companies, and he now has the regulator that is now responsible for making sure that regulated firms are doing this at scale. So I think, and I think the first announcement of, come on guys, don't rebadge existing funds as ESG suddenly, and that kind of getting stopped is a sign of where things are to come.
And Manjit, a European focus, how are things?
Yeah, I mean, no, I mean, I think that a lot of the work that's being done is done in coordination, obviously, and then obviously the EU is very much leading the way on a lot of the legwork. So we do think that will be foundational also to things that happen in the US. There was an announcement that China would align, that the taxonomy that China is intending to roll out would also align. So I think that is positive for the world, that there is at least agreement on how we define ESG and positive impacts of products and services.
Excellent. So look, we're into the last minute, and I know a couple of you've got a kind of hard stop, so I'm not going to embarrass everybody by asking another question and then seeing faces gradually drop off. But thank you very much, all of you, for a really engaging session. Appreciate all the input, and obviously you bringing your experiences to the table. I'm sure we'll have a lot of positive feedback from the attendees. So thanks again. Appreciate it. Enjoy the rest of your day.
Pleasure.
Thanks, Andrew. Thanks, audience, for your questions. Much appreciated.